Check one, two. How's
Yeah,
it going?
check one, two. Good. How are you doing tonight?
Oh my gosh, I'm just super stoked to be here. We got some good stuff going on.
We do.
Oh my
It's
God.
uh it's a beautiful day up here in the North Woods. So
Is it?
yes.
Awesome. Every day in the summer is beautiful when you're,
No, it's been a great summer.
yeah, enjoying yourself. Yeah, for sure. Well, welcome everybody. This is Paul Horsley along with Dave Forbes.
Hi everybody.
We're the Financial
Hi.
Prodigy, where we talk about the good and bad things about money, mostly good,
Sometimes bad.
sometimes bad, but it's not about IBC, right?
That's right.
It's awesome. Well, we're gonna kind of go over tonight what makes IBC so exceptional, and how we can implement it in our day-to-day lives. And we're gonna just review how it might look in your world, and certainly how it looks in Dave's world and my world. And this is going to be a great overview that you can actually see the implementation of how IBC really works. So I'm going to hand it off to Dave, and I hope you enjoy this as much as we do.
Hey, thanks, Paul. First off, I want to have an apology. It's been a busy few weeks. Our last one of these was almost a month ago, and we got a little delayed from camping trips, family vacations. Actually had to go to work one night, and some other things. And so our apologies. We had the best intentions of doing these every Monday night, but as they say, the road to hell, ... So we're doing as much as we can. Summer every week may be tough. When winter shows up, I bet we'll be a little bit closer to every week. Also, a couple of reminders. We do have a new website. It's about a month old. We've got quite a few videos on there in the resources section. It's down at the bottom of the page. You have to go hunt for it. We've got our own stuff. We record these sessions. I do a little editing and I put them up on our website. I also put them on our YouTube channel. If you search YouTube for Financial Prodigy, you will find our channel. I also throw them up on our Facebook groups and our Facebook page, and they're there. And I usually announce there the direction back to the website to find them. The website ones, just because we don't want YouTube for some reason to cut us off. The videos that we do of this on our website are hosted not through YouTube, they're through our own servers. And so you won't be in the YouTube world, if that means anything to anybody, if you go through our own website. If you have a chance, like us on Facebook and do the Twitter thing and find us where we are. We try to, throw out information as much as possible. It is just Paul and I, so it's mostly things we find interesting. And once we post it, it's just for your own consumption. A lot of it's IBC, but a lot of it is stuff that deals with the Fed and money and libertarian politics, things like that.
Yep.
Periodically, Paul goes off the deep end and we'll post flat Earth stuff, but we'll just leave that one alone for now.
Hey,
Anyway.
we love all things about money, and over these months to come, I'm sure we're going to be talking about a whole plethora of different things with and without IBC. We're going to circle around a lot of things just to kind of educate on a lot of different levels for everybody. So we're pretty jazzed and jacked up about what's coming down the road for us. So anyway, yeah.
Okay, so in our last discussion, we've been kind of working our way through Nelson Nash's book, Becoming Your Own Banker. It's not the easiest read. It's a very simple tome in terms of length, but a lot of it is done with analogies, and Nelson dances around things. And he tried to write it. It was written 21 years ago to be more timeless, but some things have withstood the test of time better than other parts of the book. But we basically have been working on it chapter by chapter. And we're only about a third of the way through the book right now. But one of the things that we keep getting asked from our clients and from people who are interested in IBC is, okay, I have an IBC policy. You've designed me an SDLIC, a specially designed life insurance contract. I'm throwing money in, I'm saving, the cash value is growing. Nelson says, use the loans for buying cars or whatever else, but how do I do it? Do I just take out a loan and then start paying it back? Well, you can do that, but it's not really the most efficient way of designing basically your real life banking system and how to implement it in a proper way. What Nelson was all about was something called the velocity of money, moving money through your system in and out as much as possible, speeding it up, grabbing interest and profits where you can, but all keeping it within a closed system. Well, it's easier said than done. And there really isn't anything in the book that says exactly how you're supposed to do it in today's world. So with the help of the Infinite Banking Institute, last February, Paul and I were down at the think tank, and one of the presenters put on a really nice presentation about how to implement a real life banking system. And his name's Vance Lowe, and I'm going to give him credit because I copied a lot of his material for this. I'd love to say that I'm the smartest guy on earth and I came up with myself. Oh no, was it Picasso that said, great people copy or steal or something.
You know
like
what?
that?
Everybody copies somebody, and there's really no original thought out there that is,
So anyway, I've kind of put together a little presentation on what do we do. We've got an IBC policy. We're being smart with our money, and we have a budget. We're staying within our budget. But it's just, I don't know how to make it all work. And so I'm going to kind of go over some things today. And basically, we're going to set up the other half of an IBC policy. We have some very simple goals when we're doing this. The first goal, what I call, is getting back to zero. You have money coming in every 2 weeks, every month, and it flows back out. You pay your bills, you pay your mortgage, you pay your car payments, you buy food, you pay your utilities, you pay for school, you do all that stuff. But in what happens in the common commercial system is money comes in, it goes to a bank, you then write checks, use debit cards, whatever else, it goes back out and it flows to various sources. Many of those sources are owned by that same bank to whom you pay interest on houses, cars, et cetera, lines of credit or credit cards. And at the end of it, you have no more money, or you only have a little, and that goes into a quote savings account, which doesn't earn any interest. And you're worried about if you're making it 1% or 1.5% on what's left over at the end of the month. And what we're trying to do is, and it's basically an open loop system. And what we want to do is get away from that. And when I say getting back to zero, what I mean is no money flows outside of our system. We want to develop a closed loop system. And within all this, we want to get out of debt. We want to stop paying interest to the banks. Average American is 37%, Paul? Is that what the number is right now for interest?
That's really close. Yep.
Yeah. The average American pays 30% of their gross income in interest every month. And if you figure the other, and that includes mortgages, but it doesn't leave a lot on the other side, and that money goes out the door and never comes back. So I said, so basically what we're going to do is I'm going to show you how to develop what we call a closed loop system. But first, the good foundation is, well, what is an open loop system? Like I said, an open loop system is basically this. You earn money, okay? That money goes into a bank, whether it be a checking account, a savings account, money market account. What happens when your money hits the bank? It goes back out of the bank when you spend it. And spending, what I mean is anything on your everyday expenses plus all the other stuff, your mortgage, your car, everything else, you spend it. But how do you spend it? Well, a lot of that money you're spending that goes back, that's going into the bank, goes out of the bank and right back into the bank in terms of, because you've got loans with the bank and you're paying interest on those. So at the end of the day, the open loop system, here you are with a couple of dimes in your pocket, and all the money you started at the beginning has now flowed in and out and is gone.
Let me just insert something, and that's a great point, Dave, because the money that we do have to save, we're putting it in a 401k or an IRA, and then we're having to go another part of the system and use a bank to finance our life, and that's exactly what Dave is showing you here.
Exactly. And who's the winner in this? Who shows up twice in this little diagram? The bank.
Yep.
They're basically paying you a pittance on your deposits and then charging you a lot on the other side for the loans you have, but they make money on both sides. And so we want to get away from an open loop system. And what Nelson was stated in his book and what IBC practitioners have been taught is to teach a closed loop system. And that's where we're going from. We're going to talk a little bit about that. A closed loop system basically keeps the money in-house. Whose house? Our house. And how do you, and so what we're going to do is we're basically going to build your house and show you how to keep the money in. A closed loop system has owners, and we're going to run this like a business, but it's for your own personal life. Basically, the owners of this closed loop system are you, because you will fund the system either with current income or other investments. You're going to capitalize your system. The other owner of the system is the insurance company, because if you have a properly designed IBC policy, you're going to be using your cash value for growth and for funding this closed loop system. And when I say others, it could be anything from basically other assets you have or anything like that. Okay, so let's look at us. We're gonna basically split ourselves in half right now. Half of us is going to be the owner, and the other half is going to be the client. Okay, what you need to do with a closed loop IBC system is open what we like to call a clearing account. And a clearing account is just that. It's a personal checking account that is not the account that you pay your bills with. Make sense?
Yep.
Okay. The only thing this is used for is for you to capitalize it to run your bank. That personal checking account, and yes, we're going to have to use a bank to do it because that's just the way the system works, but we're going to build our closed loop within the system. You're going to capitalize your account with either current funds, and as time goes on, you're going to use capital from your IBC policies to loan to your clearing account to fund your client being you. Okay. When I say clients, there it is, you, but I call it counter you. It's the opposite. Counter you loves to spend money. Counter you takes everything that comes in. You're that guy in the previous slide that he looks at the end of the month and he goes, I got nothing left. I've spent it all. Okay. So what do you do to in the open system to create the you again? You go back to work and you provide income, right? And then it all goes out. But what we're going to do is we're going to set up a budget, and we're going to use us as owners to fund us as clients in a closed loop system. Like we said, client you loves to consume capital. So we all have personal checking accounts. That's what we pay our bills with, okay? The personal checking account for the client is not the same account as the clearing account, okay? And here's another recommendation with this. Both these accounts are personal accounts. You do not want to have a business account with these because it starts tracking, the IRS starts tracking it, and they want an EIN number and all this. It's just two separate accounts. You've got, the way I have it, I'll just give you, where we do our banking at, we have our main account and we have our clearing account. It literally says clearing account on the checks below our names. And that's how we use it that way. And when you use your personal checking account, though, is the account that you do fund the daily living of your life with. Out of that account, you pay your expenses, you pay your car loan, you pay your mortgage, pay your credit cards, you pay for your or your children's or your grandchildren's education, you buy your insurance. And like I said, how does it work? The income goes into the clearing account. The clearing account loans monthly budget to the personal checking account. Personal checking account pays the expenses on a monthly basis. And then the monthly income from you goes back into the clearing account and pays back last month's loan with interest. Does that seem like a closed system? It is. And I'm going to show you how it works here in just a second. So here's our basic, our keystone slide here where I showed our personal checking account and the money flows out. And so let's say I'm going to use a guy named Paul for an example. So Paul makes $5,000 a month. Okay. He deposits his whole paycheck into the clearing account. And through some work, maybe on his own or maybe with a sharp IBC practitioner, he's developed a budget. And Paul's budget is going to be $4,000 a month. Now I showed here at Capitalize. Basically, you can capitalize this account with, like I said, with your own funds, or if you've got a, cash value in your IBC account, you can loan it from your IBC account into your clearing account. If you notice here, I said capitalize at 9%. I'm just brutal with myself when I do this. I basically set up a loan from my IBC policies into my clearing account, and I charge myself 9% interest. The way I look at it, I'm going to have to pay 5% interest to the insurance company. Okay. I'm here to make money within my closed loop system. So I'm going to budget and make sure I pay myself back at 9%. So I make money on the loans I'm taking out of my policy. Or if I'm borrowing it out of cash, I'm going to pay myself back at 9%. It's just the way it works. Remember, we're not really worried about the interest rate. We're worried about the velocity of money. We want the stuff to move through the system as much as possible. Getting back to Paul's income here. Paul makes $5,000 a month and he deposits it in his clearing account. He sat down, he's figured out a budget. His budget is $4,000 a month. Everything that he needs, all those items that are the outbound arrows from his personal checking account are equal $4,000 a month. It could be a little more, it could be a little less. Maybe he needs to put a little bit aside for tax payments and things like that, but he plans ahead and it works out to that, okay? So the money goes into his personal checking account and he pays back his bills. So now what has he got? He's got a $4,000 line of credit sitting out there against his clearing account. When's he going to pay it back? In the next month. So his next paycheck, he's going to deposit $5,000 into his clearing account. What's going to happen with that $5,000? $4,040 of it is going to pay back the loan from last month. Why $4,040? Good rule of thumb, charge yourself 1% a month interest, okay? So there's his 1%. And so $4,040 gets paid back into the clearing account, and he immediately turns around and lends client Paul another $4,000 for next month's expenses. The great thing about this is month number one, you took in $5,000, your clearing account is sitting now newly capitalized with $1,000 of extra money. Okay. And that's just the first month. If you do the budgeting right. Month number two, he's sitting there, he deposits $5,000 from his paycheck, pays back the loan with 40. Now his balance is sitting there at $6,040, lends out his $4,000 for the expenses for this month. And look at this, $2,040 in the account, and on it will go within this closed loop system. Basically, you are growing capital. And what we're doing here is you're going to use that capital for other things later on down the line. This is just the beginning where you start basically taking your personal expenses and creating this looped system. So after some time, Paul pays off his car. He's been making monthly payments. Let's say those payments are $400 a month. Okay, car's gone, but now the car's old, so he needs a new car. Are we going to go to the bank? No, because month after month, we've been capitalizing our clearing account to the tune of about $1,000 a month. But let's say we don't have enough in the clearing account to buy a new car. Where do we go? We go to our policies. We loan money, we borrow money from our policies into the clearing account to buy a new car. Okay, you buy the car, but now you got to pay the clearing account back. So you basically set up a loan. And like I said, we were paying $400 a month before. So now we're going to keep paying $400 a month. What's the loan rate going to be? 10%. Well, what the heck? I can get a car loan for 4% right now. That's not what we're focusing on here, folks. What we're focusing on is the velocity of money. You want to make money on what you are charging yourself in capitalization. And if you were paying $400 a month before in your monthly budget, you continue paying yourself $400, the clearing account $400 a month. You don't care that it's 10% interest. You're going to just pay $400 a month. Those paid off. That's the way this works. Okay. So the new loan now basically is not going outbound. If you've noticed down below in the personal checking account, it's not pointed out anymore. The new car loan is going back into the clearing account every month and paying down the capitalized debt that you took on amongst yourself. Quick little side note on loans. My recommendation to you is when you start this system, make loan documents and sign them, even though it's between you and yourself or you and your spouse. It holds your feet to the fire to make sure that every month you make sure that you pay back these loans. Okay.
Just keeping you're playing honest banker with yourself.
Exactly. And if you were doing this where the money was still going out, where only a little bit of it was going to pay off your principal and the rest was going to interest at the bank, you do that yourself, or the bank would come and repossess your car. And so you have to do it. And you're being honest with yourself. And what you'll find then is your capital will continue to grow because you're paying yourself back here.
Nelson calls it stealing the peas.
Yes.
You don't want to steal the peas.
You do not want to steal the peas.
No.
But see how this works? And so now what we're going to do, though, is let's move on to credit cards. Lots of people have credit cards. And I'm guessing, but I think the average interest rate in the U.S. right now is 22% for standard credit cards.
That's crazy.
And it might even be higher. It's been going up the last couple of years. There are some credit cards out there that are 27.9% right now annual. It's just crazy. So let's just take a look at credit cards. You know, it's you've gotten your car loan, you've gotten your other car paid off, and now you've got enough capital in your clearing account that you look at it and say, hey, I've got X number of dollars. My credit card balance right now is basically less than that. I'm going to pay off my credit cards. But are you just going to pay them off and do nothing? No, because this is a closed loop system. If you didn't have the money, you would be paying the credit card company your, let's say, $500 a month. Okay. So you're going to continue paying that $500 a month. But what you're going to do is you're going to pay off your credit card and take out a new loan against yourself in your clearing account and continue to pay the $500. Credit card goes away on the outbound, but all of a sudden, here it is. We loan it out, we pay it back, and we're going to take it out at 22%. And here again, you're not trying to steal the peas. You're going to play fair and say, if I was paying this anyway, I would pay it out at 22%. I'm going to pay it back to myself at 22%. And you're going to continue paying your $500 a month, still staying within your $4,000 a month budget. So you're still spending less than you were spending. I mean, less than you were taking in, but now it's all coming full circle within your system. And the credit cards then start flowing back into the clearing account and not out to American Express or US Bank or whoever you're going to do that to. And you'll find then is all of a sudden that disappears. So we've got some things left, and let's move on to the rest of the stuff. I have education on here. I say student loan payments. Now, that's why or you've got kids you're paying for college or whatever else, and you're financing it. Well, let's take care of all that. So all of a sudden, education, we move that into, we capitalize, pay off that debt, bring on a new debt within our own closed system, and all of a sudden, education's there. You've got your IBC policies, you've got other insurance, you've got premiums that come due, you plan ahead. It's all within your $4,000 a month budget. But instead of financing that, it's going to all come back in. Here comes your insurance. Insurance starts there. And then the last thing, and now what's happening in this is the snowball is beginning to roll downhill faster and faster. Your capital account is growing and growing because previously this $4,000 a month that was going out into the ether is now coming full circle back into your system. You're paying back your loans, you're capitalizing and paying down debt, and basically you're going to get to the point where all of a sudden you're going to see your capital amounts is enough to pay off your mortgage. And you're going to turn around and you're going to pay off your mortgage. Are you then going to stop paying your mortgage? No. You're but you're going to pay it to yourself, basically, is how this works. You are going to take out a new loan against yourself, and you're going to pay yourself a market interest rate, and your mortgage is going to enter the clearing account, and it's going to basically start funding itself within this closed loop system. If you notice, I have expenses still pointed out the bottom there. There's nothing we can do about expenses. I mean, you've got utilities, you got food, you got gas for the car. It doesn't really work within the system to keep the velocity going around and around.
At least for the conversation, at this conversation.
For this conversation, I'm trying to keep it simple.
Yeah.
So basically, out of that $4,000 a month, let's just assume that expenses were $1,000 a month out of that. And so by the time you've got all this taken care of, basically only $1,000 is leaking out of your system every month, and the other $3,000 is staying within the system, paying you interest, paying down debt. And now the great thing about this is this debt, when you've paid off, when you take a car loan out for yourself, guess what? You go pay cash for the car. So the car is titled in your name. Nobody can ever take it from you. You pay off your mortgage. Guess what? You own your house. Nobody can take it away from you. You are paying yourself back, but this is a system within yourself that no one can mess with.
And Nelson says what? Secede from the system.
Secede from the exactly.
From the system. Get rid of that noise.
And so let's say we're 7, 8, 10 years down the road, and we've been coming to these Monday night meetings, and all of a sudden someone turns on their microphone and says, Paul, guess what? I've paid off everything. All my internal loans are paid off. I've got $4,000 a month coming in, but now my budget is really only $1,000 a month. I've got nothing. What do you do? Well, as Nelson said, that's where the true power of this comes in, is we take the excess capital and invest it back in ourselves in more IBC policies. You buy more policies, and if you have lots of capital, you front load the policies, and then you go out searching for places that will give you a good return on your money.
Yep.
And it becomes a system, and it's basically it's planting a seed and letting it grow. And by the time we get to this, we've got the big thick oak coming on. So
I love it.
Anyway, but I guess the hardest thing for us to grasp as new to IBC is exactly that, is that it's a long-term system, and we have to basically budget and look at what our end goals are and stay within the system. Don't steal the peas, and look at what's going to happen when all the debt is gone and we can start using our capital for bigger and better things. Paul, just real quick before we take some questions, a lot of the people who have done this system, and this is the post-purchase of an IBC policy, will you agree they find themselves basically debt-free within 7 to 10 years?
Yep.
Including their homes.
Yep.
Yeah. If they keep within the system and they don't steal the peas.
Right. Right. But again, it's a system that they have to follow and to be successful. But
yeah, and just that's
simple.
And that's the reason we're having these discussions on Monday nights, is that there are questions all the time. How do I do it? How do I make it work? And we're just now, this is just the surface of touching it. It's to give you a general overview of how this works. I can't be more fervent in my belief that you have to get set up with a clearing account. You have to separate your capitalization from the capitalization of, from the actual expenses that you're using. So.
Yep.
Anyway.
Greg has a question, I think.
Okay.
Let's see. Go ahead, Greg.
I think you got to unmute him, Paul.
There. I just unmuted him.
Okay.
Go ahead.
Can you hear me okay?
Yeah, go ahead, Greg. Thanks for coming on.
Thanks. I'm 71 years old, and I want to use a single premium whole life to try to do the same thing, because I understand with a single premium whole life, you can put money in and pay it back and reuse it over and over again. How does that work for somebody my age?
Well, simply answering that question is probably not going to happen. And when you say single premium, I just want to be clear for everybody. You're talking about just one deposit and then done, right?
Yeah.
Okay.
I'm looking at doing like a series of policies.
No.
And
I mean, you're
yeah,
just
one and
coming to
done.
the
Yeah,
table once and done, right? Is that what you're asking?
exactly.
And so IBC, you can do that, okay? But my come from and my discussion always goes back to you are always storing money somewhere, right, Greg?
Correct.
Okay, and that I mean, if you didn't have an ongoing sum of money that's coming into your world every month, then you probably wouldn't be existing, right? So I don't know what your world looks like. I don't know anything financially about you, but I need you, just like every other client that we have and we talk to consider how much you have each month or each year. Let's just call it each year for real simplicity purposes. There's an amount, an extra amount, typically, whatever that looks like, that you can run through the system at least to store it and then come back around and then borrow out of it and then continue to move forward. So I understand what your one and done idea is, but if you're going to do that, consider looking a little bit further down the road at 71. So at that age, you should be able to, well, as I've said in the past, there's three pieces to every policy. There's the owner, the insured, and then the beneficiary, okay? So you could insure, if you have kids or a spouse or grandkids or that kind of thing, you could take that same money and buy a policy on one of them, and then that would give the policy a couple of things. One, you would still have full access and control over the policy, okay? And you could continue that, and at some point, down the road, whether it's next year or 5 years or 10 years or whenever we graduate from the earth, then you could simply have that rolled over to the person that was insuring. It would be a simple transfer of your money. Also, they would control it, and then they'd find a new beneficiary. Okay, so okay, I went down a little bit further down the rabbit hole, but your first
I
question,
understand what you're saying.
yeah, your question,
I'm just saying that now my particular situation, get real brief. I don't have kids,
okay. And so
and
what was your question?
yeah, I'm trying to figure out a way that I can get money out of a single premium whole life
Yep.
and use it for emergencies, caregiving, or whatever. And then I still got money coming in every month, so then I could pay the money back and use it over and over and over, like an infinite banking concept.
Yep. And so are you saying you have one already, or are you saying you'd like to set it up and then utilize it?
I'd like to set one up and utilize it.
Okay. Well, that would be,
I've got an IRA now and things like that, and
yep.
stocks and bonds, and
Yep. That
and
would
I'm
be
still working. I'm still working, so I have a monthly income still coming in.
awesome. And so do you have any kind of, any relatives younger? And I don't mean to say that derogatory. I'm just asking what your world looks like.
Yeah, it's just me and the wife, and she has some nephews and nieces.
Okay.
So I would do that with them, and then they got grandkids.
Yep. And I'm only asking that because the window of time between 71 and 75 is just, it's probably 3 years plus some months. Okay. So that's important to understand, because at year 76, you can only deposit in your IBC SDLIC system the base amount of money in your policy. But in a one and done kind of a scenario like you're talking about, that we would have to just look at the illustration in a separate conversation, because I typically, I really try not to do, Dave and I try not to do single premium policies, because because everybody has an ongoing income and they're storing their money somewhere. So you've got to take that into account. I understand what you're asking, but I can't really answer it right now. And so I would say just, let's set up another time and run some sample illustrations so we can kind of review what you're talking about and look at a couple of different scenarios, really, Greg. But that's a great question, and I thank you for asking it.
Thank you.
And Greg, just to add to that, single premium, it's attractive in the sense, like you say, one and done. You're looking down the road and saying, I just don't want to have to hassle with this anymore. But there are other ways with SDLICs that with 10 pays and things that you can front load those. You can get a better return. You'll get a better return on your money in a much higher growth rate in your initial cash value of the policy versus the single premium ones. The cash value does not grow fast enough to make it work the way we like to see it in an IBC policy. That's the reason.
That's excellent. Yep.
I see. Okay. I didn't think of that. So there's a way that I could start another policy. I just have to put it on my nephews and nieces to do what I want to do.
Absolutely.
Yep. And then when you graduate and are no longer with us, you're going to be their favorite uncle for a long, long time.
Oh yeah, baby.
Yeah.
But you got a lot of years left, Greg.
Yeah. And you use it. They don't even have to know they have it until, you're done using
I wouldn't
it.
tell them at all.
Yeah. Exactly. I love it. Anything else?
If they're Democrats, they may start plotting something.
Exactly. All right. Does anybody else have an additional question this evening? You're welcome to ask it. Jeremy, go for it. Let me see if I can unmute you, sir.
I'm unmuted, I think.
Yes, you are.
Go for it. Thanks for joining us tonight, Jeremy.
I finally was able to make it. I actually
Awesome.
got home a half hour ago. So I absolutely love the idea of the clearinghouse account. Like I love that idea. And I'm even thinking on the business side, I'm thinking about setting a separate account up that wouldn't be a true clearing account, but just every $100 that goes out the door that gets cut in checks for whatever, you take 1% for, figure out what you cut for bills in the week and for expenses in the week, take 1%, take another check and just stick it in this what will essentially become a clearing account. So I absolutely love that idea because you won't notice that being gone and you're building within. My question is that on the personal side, I would like to take different things, credit card, car loans, mortgage, all that stuff, and do what you're saying, as you get going and as your clearinghouse gets bigger and paying those off and paying yourself back. My question is that, like, if you do a roll down with credit cards, you can go online and you can plug in each individual card and it will tell you where you're at with each one and the roll down effect. Is there any mechanism or is it something that you guys would like to put together where so I could sign up for a membership or something like that and I can go in and say, okay, I'm buying this car and let's say the balance on it's $22,000, right? And I take that money from my clearinghouse and I loan myself that at whatever interest rate I set, 10%, without having to go and try to figure out an amortization chart or how long I have to do that to know what I'm paying myself back with every month back into that clearing account and when that's actually done and to track especially I can see where it can get messy when you start getting multiple loans to yourself and knowing where you are so you're not stealing your P's unintentionally, I guess is what I'm asking.
Paul, you want me to take that?
Sure.
Okay. Jeremy, my graph got a little convoluted there as I'm drawing arrows all over the slide there, but really what it involves is you've got a budget right now, this money flows out and it doesn't change a lot. It's about 30 minutes a month on a spreadsheet of tracking your stuff. Now, what you said, what we do with our clients is I want to model a loan. You call Paul or I, we sit down and we model you out a loan and we've got the software for it. We can make it in a couple of minutes for you and say, if you're going to take out $35,000 to go buy a car with, and you want to have, and your current monthly budget is $400 a month for a car. Okay, here's the amortization table that's going to keep you within your budget. And like I said, because of the velocity, we don't really care what the interest rate is. It's just got to be higher than what your capitalization rate is, and we'll make it work. And send you a spreadsheet, and you can then just, plug it in yourself and check it. And every month this is really corny, but I write numerous checks to myself every month. Within the memo, it says, this is for the mortgage, this is for the car, this is for the wife's car. And I know it seems like a lot more work, but it really isn't. It's the same time you sit down, you pay your bills once or twice a month, and then you do the exact same thing, but you're just paying yourself, and it's going into the other account. I don't even write checks anymore. I just do, online transfers, but I put it in the memo what it's for. But the whole thing of, like you said, you didn't want to model your own loans. That's not a big deal for us. We've got software to do that. And we've got a whole package that can sit down and roll down from either roll up from the lowest loan amounts or roll down from the highest loan rates of what we want to get rid of in a set. And we'll set you up on a plan to do that.
Cool. Thanks.
Yeah. Thank you. Anybody else?
We're approaching 45 minutes, Paul. You know what that means.
It's awesome. We are on time, guys. All right. If nobody has any other questions, we certainly appreciate you being here tonight. We love sharing IBC, all things IBC. So if nobody has anything else, Dave, do you have anything else to
Well,
say?
I just want to say, when you all get our emails, usually the day or two before that we're going to do Monday night, and then you get one at 6 and one at 6:45. Just to remind you, I've purposely made them from both me at once or Paul on the other one, and those are our return emails. Okay, so if you've got something you want to learn about, and we haven't sent out what our agenda is for the next week, and it's something that's really a burning issue with you, absolutely. Email, text, write, send a carrier pigeon, tell Paul or I what you want to hear, and we'll do it. Or if you just have questions you want to be answered at the end of our next session, please do that. But feel free to reach out, and we'll get back to you. If it's a question for Money Monday, state that in it, and we won't get right back to you. We'll just prepare. We can prepare a half an hour thing around it and go from there.
Yep. I mean, education is key to this whole thing. And listen, you can feel free to share these emails with your friends too and family. So everybody needs to hear about IBC.
I almost didn't answer because it said anonymous.
I'm sorry?
Yeah, it said anonymous, so I almost didn't even answer it.
All right, guys. Well,
anonymous because it said anonymous.
Yeah.
You got to mute Greg.
So anyway, thanks again, everybody, and we'll see you next week. Dave,
all right. Thanks, everybody. We'll see you next week. Appreciate you stopping by.